Well, all the technicians, I mean, really everyone's been wrong this year. It's been really tough. I think that, we only got, a Friday rally in 1 hour on Thursday. And if today we had, once again, a big sell-off, the Qs were down. The only thing that was positive was really energy, healthcare, and maybe utilities, but energy and healthcare. I just think, Scott, we're in this conundrum that unemployment's low, the consumer's healthy, and the conundrum is that that's going to give the Fed a runway to continue to raise rates. Now, also, gas prices are up in May over April, and I'm pretty sure food commodities are also going to be up May over April. And so when you look at inflation slowing, I think really where the market's so weak is I don't think month over month, when we get the numbers in a few weeks, are going to be slowing. We're still moving in this higher inflation, stickier inflation, and just equities just don't do well in that environment unless you're in energy.
And let's be honest, right? There are people, Bryn, you've heard them. I mean, we hear them all the time. Oh, the Fed is going to turn more dovish if the equity market continues to look more ugly, right? And as Richard Fisher said, from your neck of the woods, the former Dallas Fed president, is you're looking at the wrong thing if you think that the Fed put is still somewhere down there, wherever the equity market may go to trigger it, as long as credit markets don't start acting too squirrely, and they're not, the Fed is not coming to your rescue.
I would totally agree. I mean, the credit markets have just been, moving up with yields, but they're definitely very quiet right now. And so I don't think that the Fed is going to come in right now because, once again, they're trying to slow down the economy. And so I think we're range bound on the upside because why would we get a meaningful rally, Scott? Why would we get a meaningful rally when we know the Fed is just going to come out and talk tough and talk hawkish? It's just going to bring the market down. And so, I mean, there are years, unfortunately, when equities go down, and I could paint the scenario where this is one of those years where we just stay down. I just think it's really complicated to look at even 6 months and say, yeah, the back half is going to be better because of midterms. That historically happens. I just think we're in uncharted waters, and you really have to go back to the 70s to see when inflation was this high and inflation was this far over the 10-year Treasury. And I just think it's somewhat of a new playbook, and most investors just aren't ready for that and are still waiting for a buy the dip type when the Fed comes in and pivots. I think they will pivot, Scott, but I think they're going to pivot when something breaks.
So, Greg, if we're in these uncharted waters, as Bryn suggests we are, where's the life raft? Where does it, is it energy? Is it healthcare? Is it staples? The obvious plays that continue to work, including today. I just looked before we were beginning the program today, S&P sectors that are doing the best, and it's, of course, those.
Yep. Look, and I think that that's right, that what has been working will continue. Scott, my overarching philosophy is that I like to look at companies that have sustainable growth tethered to a secular tailwind, that have pricing power, that have margins that are at least insulated, but hopefully showing you some margin expansion. And so you'll find that in many of the sectors you just named, looking at energy at Kinder Morgan or ExxonMobil, looking in financials at Visa and MasterCard, I've liked those names for a while. And some of these banks, as they start to get very, very close to tangible book value as well. And of course, healthcare, which has the ultimate pricing power as well. But one thing that Bryn intimated at does concern me. And that is that very healthy consumer balance sheet, that very healthy household balance sheet, we're starting to see the cracks in that. We eliminated $83 billion of credit card debt during the pandemic, but that number soared by $41 billion in February and $52 billion in March. We had 229 million applications in the first quarter, which is above pre-pandemic seasonality. And so you're starting to see the savings rate go down. You're starting to see the consumer lever up. It'll be a good summer for travel and entertainment spending, which means it'll probably be a good summer for those stocks. But the back half is treacherous.